Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Jordan Roy-Byrne, editor and publisher of The Daily Gold. And we'll put a link to The Daily Gold down below so you can follow along with Jordan's thoughts. But Jordan, it's great having you on the show just to get your technical outlook and macro fundamental outlook on how things are setting up in the markets. Last week when we talked, we did discuss that you think, in a general sense, the bottom is in for the precious metals. The rally we've seen the last couple months has really broken through some resistance levels and put in enough strength that it gives one the credence that we've seen the worst of it. But we still keep hearing from people that they're expecting one more final washout, that they want the sector to see one more capitulative move. I mean, I would submit that 7 months in a row of gold going down last year on the monthly candles was a pretty big capitulation, but we still keep hearing that message. What is your response that we would have to see the general markets and gold and everything get sucked down into some big event this year, maybe based on a recession, maybe based on some kind of a black swan? Are you concerned that there could be this big final washout that some people are worried about?
Absolutely not. There's no reason to be concerned about that. We're not seeing any warning signs in the technicals or fundamentals or sentiment indicators. This is not a repeat of 2008. This looks much more like the 2000 to 2002 bear market. There's quite a few similarities to that. And 2001, I mean, the latter part of that bear market, you had the recession hit, but before that, the Dow was pretty strong. It wasn't even that far off its all-time high. So I think that's how we're going to see this thing play out over the next year or so. And I don't see any evidence that we're going to see kind of a repeat of 2008 and there's going to be this huge crash in the market. It's going to take everything down. We have to understand those types of moves. I'm thinking about 2007, 2008, 1929, to 1932, that bear market. There's major credit stress. There's major financial stress. The financial system, the banking system, there's major problems in those areas that lead to forced selling everywhere. And we're just not seeing any sign of that. Now, sure, there's going to be probably a few problems in those areas. I mean, this is not my expertise, but just judging from the technicals on those markets and the way the market is trading, there's just nothing that would indicate that we're going to see a repeat of 2008 and 1929. And, even people were saying, oh, well, there were black swans in 2008. That was setting up. I mean, technically, there were signs of that setting up beforehand. The financial sector, housing stocks peaked, I think, in 2006. Banks and financials early 2007. I mean, the stock market itself didn't even peak until latter part of 2007, I think October 2007. And at that time, I mean, precious metals were faring well, but even into late 07 and into 2008, the miners were underperforming the metals really badly. Silver wasn't doing as well as gold. So you had all these signs. And, I remember, not to go off topic, but I remember I was emailing with Frank Barbera in early 2008, who's an outstanding technical analyst that I've learned a lot from. And, and he was in early 2008, and he saw this all coming, and he said, no, the gold stocks are going to get crushed. So I guess my point is there's just no evidence that that type of thing is going to happen. Now, look, we can't see the future. Predicting the future is really hard, obviously, but, we have to go by probabilities and that sort of thing. And I just don't see any probability that that's going to happen. Again, I think that we could get something that's closest to 2000, 2002, where the recession came in the latter part, the ending part of the bear market. I mean, you did have a sharp move down, I think, at some point in 01 or 02, but that was close to the end of the bear. And sure, I mean, we could see a sharp move down in the stock market at some point. It would probably some point this year, but I don't think we're going to see the miners and silver get hit that hard when that happens. Like, surely they'll get hit to some degree, but it's not going to be some massive down move like we saw in 2008.
Well, and Jordan, another point that I would submit is that back in 2007 and 6, the precious metals market had already rallied for 6 or 7 years, from 2001 through 2007. So it was more widely held. And we saw the same thing coming out of the great financial crisis from 2009 through 2011. there was almost a gold mania. I mean, there was people on the streets with sign shakers saying, let's buy gold. There was TV commercials, there was radio commercials. It was actually on people's top of mind. A lot of those people don't have an allocation to gold or silver now, over a decade later, and a lot of the funds that had commodity desks have closed them down since then. So the washouts that we saw in 2013 or that we saw in 2008 really were from levels where gold and silver had done much better for much longer, and that was a capitulative move. I would submit we don't have that same kind of breadth, and we don't have the same kind of volume today, and we don't have the same kind of interest in the sector. What do you think of that idea?
No, you're absolutely right. That's a great point. And I think I made this point, the editorial I wrote last week. Yeah, precious metals in 2008, as you said, I mean, they had performed really well for 7 years. I mean, if you look at where precious metals are right now, gold is basically at the price it was 11 years ago, 10, 11, 12 years ago. That's a long time with no upside over that 10 to 12 year period. I mean, the gold stocks are obviously down from that point. And I remember making this point when it looked like gold was going to break 1675, which it did. But I remember making this point where I was looking at data and the capital that was invested in precious metals ETFs. When gold crashed in 2013, there was still a lot of capital in the precious metals ETFs. Like, I want to say, versus on one metric, it was at one point, maybe it peaked at 11, 12%, and then it came down as the market was crashing to 7, 6, 5, 4%. And even after gold had come down and it was down to 1,300 or 1,200 after the crash in the early part of 2013, the capital, even after the crash, the capital invested in gold at that point was still much higher than where it was at the present, when gold was about to break 1675. I remember tweeting about that at some point last year. And at the same time, gold, even as gold broke 1675, gold was trending up against the stock market. So, yeah, I remember, going back to what you said, yeah, I remember the statistics. And even at this point right now, like, there's just still not that much capital invested in precious metals and precious metals ETFs. And that's another reason why gold's going to be able to start a secular bull market here.
Well, it is an interesting environment. It's the kind of thing you do see at a bottoming and basing process to build the next leg out of. But speaking of the next leg higher, we've also had some questions, Jordan, that have come in from listeners or people that have written us asking about how things may respond when the Fed finally does pause. And some people's premise is that the general markets may really start to rally and have a new wind at their back, and that may take the focus off the precious metals market, when we're hoping that it's going to be a situation where we see a decoupling of the precious metals from the general equities and from bonds. So how do you think things will play out when the Fed and other central banks finally do wrap up their tightening and they take that pause? Is it going to be bullish for all markets, and will that detract from the precious metal sector?
I think this is going to be, well, let me just say this is an initial guess because it's something I've thought about, and I've looked at a little bit of data and that sort of thing, but this is more of a guess. I think you have the Fed pausing, and then the Fed will cut rates after that, obviously, because, I mean, my view is they're going to stop hiking because they have to cut rates. I mean, we're in an inflationary environment. They love to be able to hike rates to 6 or 7%, but they're not going to be able to do that. So they'll stop hiking when they basically have to go to a cut. So I think the time between the last hike and the first cut is not going to be that long. And by the way, if you look at history, which I've done, there's quite a few times when there's actually like 5 or 6 times where the time between the last rate hike and then the first rate cut is 2 months or less. So it can happen really quickly. I know there's people who are saying, oh, they're going to pause, they're going to hold for 9 months or 6 months or 12 months. I really don't see that. I think it's going to be much quicker than that. But no, I think the stock market is setting up to probably peak and roll over somewhere between the point where they actually pivot and then they do the first rate cut. Because look, markets move in advance, they discount, they anticipate the future, and the Fed will basically have to cut rates because the economy's going into recession, the economy's weak, the stock market's rolling over. That's what's going to force them to have to cut rates. And so historically, this is pretty simple. when you're in a soft landing, when the Fed cuts rates or they ease policy, like I want to say 2018, I think was one example. I mean, you can go back to the mid 80s, the mid 90s. So there's all these examples when the Fed eases policy or they cut rates and the economy's in a soft landing, it's really bullish for the market. However, if the economy is basically in recession or going into recession and they cut rates in that scenario, then the market trades much lower. And I mean, eventually, whether it's 6 or 9 months after they start cutting, the market bottoms, the economy after that bottoms and turns up. So based on that, we're setting up for the Fed's going to be cutting rates when the market has rolled over and the economy's rolling over, going into recession. And so when they're easing policy like that, that's going to be really bullish for precious metals. That's when we should get the decoupling. But going back to the Fed pausing, I don't see that being like a real major catalyst for the stock market. I mean, the S&P's already rallied from 3,500 to 39, looking at 39.52 right now. I mean, that's a pretty good rally in a larger bear market. There's really significant resistance at 4,100. So I just don't see how much more upside there really is based on the Fed ending these rate hikes. I mean, the market anticipates and it looks ahead. The market knows that the Fed is going to be done hiking rates very, very soon. Maybe there's one or maybe there's two more hikes left. The market already knows that. So the market has already discounted the Fed pivot to some degree. So that's my view of the situation. I mean, if the S&P is at 4,000 or 40.50 and then the Fed is done, they say we're going to pivot, then I would tell you, okay, the market's going to peak right now. Then the Fed actually pivoting, that's when the market is going to peak. I mean, if it doesn't happen then, maybe it happens a month after they pivot and, the dumb, smart money sells into the strength based on that news. But that's how I see it playing out. I mean, I think the end part where the Fed, obviously, the economy goes into recession, or the market will go lower first because, the market anticipates. But the S&P rolls over, it loses 3,800. The economy looks like it's going to go in recession. That's when the Fed's going to have to start cutting rates. That's when we should see the decoupling. So I think that, yeah, the ending part of it is more, it's easier to kind of form a guess on that. The beginning part, I mean, I don't know. It's possible that when the Fed actually does officially pivot and they end the hikes, it's possible the stock market could peak at that time. And at the same time, precious metals could peak at the same time. I know it wouldn't make sense, but precious metals they've been outperforming the stock market. That's exactly what we want to see. That's all great. But they've been following, the miners specifically, they've been following the stock market, since the lows last fall. And so it makes sense that precious metals could correct initially when the S&P, when this rally in the S&P ends and starts to roll over.
Okay. Well, there's a couple thoughts for investors to consider, kind of more for the medium term and even longer term. And those are just some of the questions we've been getting from people, some of the themes we've been seeing out in the marketplace. So I appreciate you addressing those, Jordan, and always appreciate getting your technical outlook on how the markets are setting up, not just in price alone, but also in relation to one another. So looking forward to our next conversation next week. We'll see where things are at that point in time, and appreciate getting your thoughts today here at the KE Report.
Thanks for having me.